Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in there. Right before we jump into the Twitter social media space, I want to go over a little bit of Cameco, which is a uranium company, the large uranium company, and the Fed funds rate, and show you kind of how it reacts to the Fed funds rate if we were to get some lowering of the Fed funds rate here, maybe later this year. So we'll go over that as well in the beginning, and then go into our normal social media space, see what people are sharing there. If you want to follow me on Twitter, it's finding_finance. And if you want to join our community, finding-value.com, where I go into all of these topics, looking for potential entry points. I'm not a short-term trader. I am a long-term investor looking for really good entry points. And yes, I do try to time my entry points as best I can. Doesn't mean I'll be perfect. No one will be perfect. And there are strategies that I use to try to um, get the best price possible. We do have Mayday coupon code, MAYDAY, if you want to try it out. And if you want to sign up for the yearly membership, you definitely get a bigger discount doing that. Okay, so we're going to go, and I just want to talk about this really, really quick. This is Cameco. Cameco is the larger, kind of the bigger company up in Canada for the world. It's really two major producers of uranium, Cameco and Kazatomprom. So this is looking at the Fed funds rate in the orange on the bottom, and then this is the price of Cameco on the top. The Fed funds rate is this orange price, and what I did is I put these green arrow or these green vertical lines basically when the Fed funds rate started to decline, really, really close to it. So would buying before the rate cuts be a good idea if we were to purchase Cameco or something like that? So if we know that the Fed funds were most likely going to go lower, we can also put the unemployment rate a little bit underneath it. Usually what occurs is the Fed funds rate comes up and holds, and then you start to see the unemployment rate go up almost every single one of these cases. And we are already coming up here recently. When you combine the unemployment rate and the Fed funds rate going lower, that is the Federal Reserve cutting interest rates because the unemployment starts to go up and they are seeing a slowing in the economy. So that's what I'm using here. And if you had purchased at this area here, you would have been better off waiting and purchasing at the bottom there. So let's go in and let's take a quick look at last bull market here. And really what would have occurred if you would have purchased it, somewhere in this range up here, you still could have purchased it at a lower price if you were more patient, or at least the same price that you did back here and not have to go through all this turmoil. When they lower interest rates, that's generally a headwind against a lot of commodity stocks, uh, really the overall market in general. And the tech stocks could be pulling back, but everything gets impacted. And think of it as a big money rotation event where money is going to shift differently in the market because of a slowdown. And then we can put the unemployment rate back at the bottom there if you guys want to see that. So you can see the unemployment rate kick up, the federal funds goes down, and then usually you get some sort of wipeout or spill in everything. That generally occurs. Now, we don't know for sure that we're going to get the same exact outcome, but that's one instance. We can also see the great financial crisis where unemployment rates started to kick up. And then we could see the federal funds rate started to come down. And then you could see the big massive sell-off in Cameco. I don't think that's the similar case this time. I don't think we're going to get as big of a selling pressure like this because I think the market conditions are different. I think that we are going through something maybe similar to this outcome over here. The reason I think it's over here is because the real estate market is in the same location. I also think that commodities are underinvested, and the the setup is much more similar to 2000, 2001, where we were going through a technology bubble, and eventually we're going to rotate into what I think will be a commodity bubble. That's your super cycle commodity, your commodity super cycle. So we're in the beginning. We're going to create what's called the bear trap here. And that bear trap is going to scare a lot of people out of their stocks, most likely, is my guess. Because a lot of people just chase price and they know nothing about value and they don't know anything about the Fed funds rate, the yield curve, the unemployment rate. They don't follow that stuff. Here's another one where it fell. So looking at the last one that fell, we peaked out here. Let's see what the overall price drop was. So we peaked out there and we had a complete price drop, about 50 or 60% there, hitting the top there and then the bottom of 2020. Now, again, I don't know if we're going to get this type of sell-off. That was the COVID event. We did see unemployment spike up, and we did see the Fed funds rate decline there. And we did get a pretty big decline in Cameco. So that also correlated with lower prices in the future. And then today, if you can see the setup here, we started to sell off here just recently. There's the selling pressure move. We've got a high Fed funds rate, and the unemployment rate is starting to kick up. So that's what I'm looking at, engaging and saying, you know what, maybe we shouldn't jump in front of this. Maybe we should wait and see. But again, we do know that the sector and the fundamentals of the sector are very good. So we're kind of in a conundrum now, aren't we? We could see an overall slowdown in the market. Historically, we've seen pullbacks during these almost every single time in history. Some not as big, like the 2000, 2001 wasn't as big of a pullback. And we've seen some monster pullbacks occur here. Timing the market is incredibly difficult. And I'm not stating that I'm trying to time this market, but being aware of what's occurring with the unemployment rate and the potential of what the Fed funds rate could do, and maybe we could get a pullback in uranium companies. That's what the value is, because you could stay long in positions, and you could prepare yourself mentally for if something were to occur. That there could be a drawdown. And if the drawdown does occur, you could take advantage of that drawdown and maybe come up with strategies of how to deploy money if we do see a drawdown, which is, in my opinion, is a likely outcome or scenario. If these things do deteriorate, the unemployment rate and then the Fed funds rate chasing it lower. So that's what I've got there. That's what I wanted to talk about there. Going through and see what people are sharing. At 3.5 million barrels per week, adding to the strategic petroleum reserve, this is oil. That's an extra 0.5% or so of global oil demand for like 2 years. If it was supply coming out of the SPR, it has to be demand going back into it, right? You can't have it both ways, says Calvin. Yeah, I agree. I think it's demand. And if they're going to be doing that, well, it's increased demand. And we generally see oil prices go up when the SPR does get refilled. But if there is this potential slowdown in the market, which, I mean, obviously they're probably trying to engineer it into the market and create demand for their bonds, because they probably have to issue a whole bunch of bonds. They can also refill the SPR up while they create this slowdown with interest rates. So I'm going to be very curious to see how this all plays out over the next year or so. The Great Marti of S&P 500 update. Following the path to perfection, 2 probable paths below. The third is a teardrop not depicted, which is the worst case scenario. But this is the squeeze up of the rising wedge. The throw over top is what we call it. Then you start to see the red army, the big red candlestick sell off. You get a big bearish engulfing. which occurred a few trading days ago. We've got the lower support line that just got ripped right below it. It paused at support and then ripped again below it. Now we could go up, and what we're creating here is a flag pattern, an inverted flag pattern, and then we sell off further. The flag pattern and the way that that flag looks like, what people call that is a bull trap. People think that it's going to return to all-time highs. They think it's going to go up. And really, it's just sucking in retail investors. They call that the bull trap, and it's an inverted flag pattern for the most part. We're already seeing that in some of the companies like SMCI. That is an inverted flag pattern that is a bear trap for SMCI. Since I have this pulled up, I can show you what it looks like. Um, and we can go in there. That's what this is. So really, you get an inverted flag pattern, and then it drops down below it. This does not look very bullish. Now, I know people look at this from a long term. They go to logarithmic and say, well, really, this is all it's pulled back. Well, you have to stack on other things. It's not just, SMCI moving on up. You want to stack on things like this was a recovery phase the entire way, and then we're going into an expansion phase of real estate, which puts downward pressure on technology. We're going to see a rotation, in my opinion. Why do I think that? Because that's what's occurred in history. And a lot of the times, what makes that possible is the Fed funds rate and the unemployment rate. Oops, put it on underneath here. It's these two that cause some problems. When you transition to an expansion phase, they raise interest rates, and then that slows down the market, and then eventually you'll get an unemployment rate. That's what pricks the bubble over in technology. So that's what I think is occurring. And that's why I think that this is most likely a probable outcome. Now, how far down does it go? I don't know. I don't know if this is going to be like the big kahuna or if we trade lower and it just trades sideways for a while. I don't know what that outcome looks like. I would be very hesitant to give my opinions there because I just don't know. But this is most likely going to head lower for a little while with the yields dropping. QE Infinity says, an analyst from UBS was reporting the same thing on Reuters. We are only about halfway through the yen carry trade unwind. So that's their opinion there. It says we aren't done by any stretch, says Global FX Strategy co-head. The moves come amid fears of U.S. recession, Japanese rate hike. So maybe we're only halfway through it, but that also coincides with a lot of the patterns that we could potentially get with this. But again, I don't know what the future is. These are only potential outcomes that people are sharing. I wouldn't get too worried. I would prepare myself mentally and say, okay, if this could potentially come, how could I take advantage of it? And if it doesn't come, what would be a strategy if it doesn't come? And what would be a strategy if it does come? And do I play it where I put all my money in one way for an outcome and all my money with the other way? Or do I say, okay, I'll just hedge myself with time. I'm going to ride through it. Maybe I can generate some cash and hold some cash just in case something like this could occur. And if we do get a potential pullback, I can unload whatever cash I've got into the markets when it looks like it's bottoming. And that's probably the strategy that I would do. Is the one where you would raise cash and try to deploy it at the best possible prices. So JC Parrott says, also keep in mind, they'll always tell you that it's just a dead cat bounce, especially when it's not. It's the same every cycle. So a lot of people try to time this stuff in the short term. And I know we're using technical analysis and we are charting the herd and the emotions of the herd. A lot of people don't get it right. That is why short-term traders are not incredibly wealthy. So those strategies, I don't deploy those strategies, but I use them to look and monitor and watch the market. It doesn't mean that it's right all the time. So I don't use technical analysis in the short term to try to time the markets for the short term and make short term trades. All I use for the markets is where's the best entry points, and then everything else is based off of the value that the business has in relationship to other financial assets. So if commodities are cheap, I'm looking at commodities and then I want to get good companies. I don't try to time the market, but I do try to time my purchases where maybe things are breaking out, they're in basing patterns or something like that. It gives me more confidence that at least I'm close to a move. Um, and you're at a very good valuation. So you've got all the tailwinds behind you. But the short term stuff, guys, I don't know anybody who's made a lot of money trading short term price movements. Another one from Great Marti, Bitcoin update, keeping it simple. He's saying that this is a mass distribution. We've broken to the downside and that we'll get a retest perhaps and a move lower. That would also coincide with the NASDAQ topping out and the S&P 500 topping out. So that is a confluence of information, all basically stating the same thing. I do think that is the case to some degree because we've got the unemployment rate, the yield curve uninverting, like all of these things are stacking in alignment. I know people are going to look at the long term. They say, well, look at this. It just keeps going up. It's like, well, they're not stacking everything on top of each other. We're also entering an expansion phase of real estate. We're not in a recovery phase anymore. It is slowing down in the short term, but if they lower rates, I think that expansion phase is going to kick back up, and they're probably going to have to raise rates again at some point. That is my ultimate overall big picture of what I think is coming. But right now, we could definitely see something like this. It's definitely on the table. Genevieve, or Genevieve, however you want to call it, layoff announcements in 2024. And this is what I mean by the unemployment rate going up. This is where it's coming from. Notice the sectors these companies are in. Dell, Intel, Intuit, PayPal, Unity Software, Twitch, Bumble, Expedia, Cisco, DocuSign, Snap, Riot, Wayfair, Indeed, Peloton, Tesla, Pixar, Discord, Lucid, UKG, Match Group, Brex, Wayfair, Riot Games, Duolingo, Rent on the Runway, and eBay. These are all tech companies. In 2024, tech companies have laid off 126,032 people. With the NASDAQ down 12% from record high, how much worse can it get? It's a rotation occurring. So what occurs, in my opinion, is that you go through a recovery phase. Recovery phases in real estate are low interest rates, low inflation. The housing market and credit expansion is very low. As you work your way towards an expansion phase of real estate, which we were at in 2020, we had a large move in the real estate market to the upside. We had a huge influx of money, both stimulus money and credit creation from the real estate market and the housing starts. It was all just gushing into the market. Very inflationary. The Federal Reserve raised interest rates very fast and they slowed that credit creation process. They also slowed all of these companies down with it. And I think that the slowdown in these companies is what's going to force the Federal Reserve to lower interest rates at some point in the future. And I don't know what that point is. Mike Simonson says it's wild that only 47,000 Americans faced foreclosures last quarter. 10 years ago, it was 3 times that amount. New foreclosures rose 7% in the quarter. At some point, the tremendous American homeowner financial strength will wane, but not yet. And this is a really, really low location for foreclosures. We are not like 2005, 6, 7, 8, and 9. These had monster foreclosures, and we're still very well, we're at a very low location. It very well could go up. I mean, we've got a lot of unemployment coming from all these areas, and maybe that has an impact on foreclosures, maybe. Or if the housing market is okay and they lower interest rates, maybe there's enough buyers out there to buy those homes and they never go into foreclosure. But we'll see. There's not a lot of forced selling going on. There's a lot of equity in the houses already. Investment wisdom, extreme patience combined with extreme decisiveness You may call that our investment process. Yes, it's that simple, says Charlie Munger. I like it. Um, Oren says, I'm mainly a gold and silver guy, but you've got to admire the massive base which platinum is building down there. At the $800 to $900 region, one day it's going to rally big time. This is what you want to see. This is like, the great basing patterns. There's also great basing patterns in other like emerging markets and stuff like that that we're going to play big time on the website. We are playing platinum. It is, I think, a great entry point in this general region here. And what you want to see is you want to see the base. Whenever you see these big candlesticks, generally you're going to have to, this is a big bounce here. Generally you base out and then you're going to see the volatility decline. So you're going to see your highs and your lows come into a point and you go into a dead period. That dead period is where the buyers equal the sellers, and generally that's where you get a big move higher. The reason I think it's going to go up is because we're at the cost curves right now of platinum and palladium and a lot of those other ones. So they're cutting back on production. I think that this is going to be, hopefully soon, a big move higher. Another thing that you can watch is the value of the dollar. Because when you get a weak dollar, this is going to go way up. That's the denominator of platinum priced in dollars. Feels so I was told there would be a commodity super cycle, is what he's got here. We are in the commodity super cycle already, guys. What people fail to realize is that you don't go straight up and it moves in waves. So if you look and you study history, which I don't think people study history that much, go look at the stock market bubble and how it moves. If you were to look at a lot of the tech stocks, they went through the same thing that the commodity super cycle is going through. You get a move off the bottom, you get a large selling pressure wave two, which I think we are going through still, and then you get the big move. And your super cycle will be obvious to everyone at that point. Right now, people are still in disbelief. They, when you look at so we can put stock market bubble, and we go to images. This is the image that I'm referring to. It's the takeoff phase, the first sell-off bear trap, which we're in, and there's this disbelief phase that's occurring over here. We get media attention, enthusiasm, greed, delusion, and new paradigm. And then we go back around. Right now, we're in the return to normal bull trap phase that's going to be created, which is the inverted flag pattern that's going to be created over in up here, over in the technology stocks. Sorry, I saw that was cut off a little bit there. Mike Zaccardi says pullbacks are common. Plus 5% pullbacks occur more than 3 times a year on average. 10+% pullbacks occur 1 time per year on average. 15% plus corrections occur every other year on average, and 20% plus pullbacks occur every 3 to 4 years on average. If you're in commodities, you're going to get way more volatility than this. And a lot of people don't like that volatility. We get 20% corrections all the time. We can get 20% up and down days in a day. Nassim on this one says, invest in preparedness, not in prediction. And then Charlie says, opportunity comes to the prepared mind. So preparedness. Here's Grady. He said last week, backtest for silver of the blue trend line at around $26 was still possible. Now we are getting that. So this is still a potential retest before the big move higher in silver. Don't give up on silver, guys. It's coming. And with the market conditions where we're at, gold and silver go up when the yield curve uninverts and yields go down. This is a perfect opportunity. Perfect. And it all is in alignment. Again, this is confluence of information. The charts match where we're at in the cycle, and this gives you further confidence that this is going to go up, not down. SunPower Corporation, one of America's largest solar companies, has filed bankruptcy. I'm sure this is just the beginning of all that. I thought that this was the future. If this is the future, then why are solar companies going bankrupt? Because it's not. Martin Pelletier says, based on what I'm seeing, tech investors, a bunch of wimps, 3-day correction and begging Fed for a rate cut. We should force them to own oil and gas stocks for 6 months and to toughen them up. Come on, people, grow up. That's what you have to be when you're a commodity investor. You got to be tough. You get a lot of pullbacks that are just nasty. Yeah, I don't like seeing my account value go up and down that much, but you know what? I like going up 25x. So I'm in it. I'm in it to win it, boys. Luke Roman says, agree. And if they don't, they will make Powell look like Ben Strong from Moment, Great Depression. And then Rudy von Heavenstein, hyperinflation, once risk-free collateral starts nominally defaulting. So what Jeffrey said is if the Fed cuts aggressively, they will make Burns look like Volcker. And what that means, so Volcker was supposed to be, he's known as the tight guy, tight monetary. Burns, everybody kind of makes fun of Burns and saying that, he wasn't tight enough. But in all honesty, he was, and the market demographics moved on him. They expanded, contracted, and expanded, and I don't know what he could have done differently. You would have had to hold, you would have to hold the rates high through a recession, and I just don't know how that works. That's what Powell's trying to do now. He is stuck between holding rates and a potential recession and unemployment going up. He's going to be a Burns. I don't know how he can't be. Like, are you really going to try to hold rates really high and just destroy the entire economy and unemployment? He's going to get so much pressure from political people to do that, to lower rates. He's in a difficult spot. Here's Egon von Greyers. He says, in my view, Bitcoin doesn't deserve to be compared to gold. Bitcoin's volatility makes it closer to tulip bulbs. Bitcoin can go to 1 million or to zero, a binary bet. Gold and silver will go to unimaginable heights in collapsing fiat money. As stocks crash, think wealth preservation equals gold. So that's what he's saying. And he's saying, this is kind of a binary outcome in his opinion. And then we got the moving, the momentum rolling over. I'm in the camp that this could go lower, but we'll see, because I think the NASDAQ will go lower, and I think Bitcoin's just a leverage bet to the NASDAQ. This is Casper here. It says gold is still luring that blue trendline breakout in relation to the NASDAQ, ready to break out here. It looks really good. This is where I think a double bottom is. Bottom one, bottom two, and a potential big move higher. You can also, if you look, draw a line through here. That's another double bottom that occurred in the short term here. So I think it looks good. And I do think that gold and silver, that gold specifically here, will outperform the NASDAQ. That's the market conditions that are causing that. The uninversion of the yield curve, the yields dropping, unemployment rate, all that stuff. What do we have here? So we've got Japan equities crash. How significant? The Nikkei in 225 lost 20% or more within a 3-week period. So this is 1990 minus 21%, asset price bubble plunge in Japan. 2008 minus 23%, post-Lehman collapse. And then 2013 minus 21%, economic stimulus panic. And then we had 2020 minus 23%, the COVID pandemic of 2020. These moves here, 21%, 31%, and then they recover after those. This is the contract truckload rates hit a 3-year low of $2.19 per mile line haul. Rates have fallen nearly 30% since the peak in March of 2022. I expect to see an increase in carriers exiting the market and rejections start to climb again. Many drivers are operating at a loss in this environment. And this is where the slowdown is still occurring. The slowdown started in 2022, and that's when gold started to take off, was October of 2022. These are some of the leading indicators and signs of a potential slowdown here. And we are still in that pullback. Here's the US dollar. It says the US dollar milkshake or bust, perhaps the most important chart out here right now, and it's the dollar dropping down here with the potential break lower. And that's what I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.